So, have you ever wondered how a company that's building something enormous, like a bridge that takes years to finish, actually recognizes its profit? Do they wait until the very end? And what about their equipment? What happens if that super expensive crane they bought suddenly isn't worth what it used to be? Well, today, we're going to dive right into those two huge questions in accounting, recognizing revenue and valuing assets. All right, here's our roadmap. First, we'll set up the problem with long-term projects. Then, we'll look at the two main ways accountants measure progress, and we'll use a bridge building example to make it all clear. From there, we'll pivot to what happens when assets lose value, and we'll finish up by walking through the two-step test used to handle exactly that. Let's get into it. Okay, so let's kick things off with the big one, the long-term project problem. This is really the core challenge that gets everything else rolling. I mean, really think about this. If your company is working on a bridge for 3 solid years, when do you book the profit? Do you show zero income for 2 years and then this massive spike in year 3? No way. That would look totally bizarre, and it wouldn't give anyone a true picture of the value you're creating along the way. And that is the timing puzzle that accounting rules are designed to solve.
So how do we solve this puzzle? Well, it all boils down to how you measure progress. And in accounting, there are really two main schools of thought on this.
This is a fantastic way to break it down. You've got the input method on one side, which is all about the effort you put in, the costs, the materials, the labor. It's like if you're baking a cake, you're measuring progress by how much flour and sugar you've used. Then you have the output method, which is all about the results, what you've actually handed over to the customer. For our cake, that would mean counting the actual layers you've finished. Two totally different ways of looking at the same project.
Okay, so theories is great, but let's make this real. We're going to go back to our bridge project to see exactly how this input method works in the wild.
So here's the setup. We have a contractor with a 3-year deal. The total price for the bridge is $2 million, and they figure their total cost will be about $1.2 million. So, a pretty healthy profit is expected.
And this is where the accounting magic happens. In that first year, the company spends $300,000. Okay, simple math. That's 25% of their total expected cost. So the rules say they get to recognize 25% of the total revenue, which comes out to $500,000. Subtract the costs, and they can report a profit of $200,000 for year 1. See? This paints a much more accurate picture of how the company is performing.
Now, this specific technique has a name. It's called the cost-to-cost method. It's one of the most common ways to apply the input method, and it makes perfect sense, right? It creates this really clear, logical link between the money you spent and the revenue you can claim.
But, and this is a big but, there's a catch. You can't just throw any cost into the bucket. If you wasted a bunch of steel, for example, that doesn't count. General office costs or marketing expenses, nope. The costs have to be directly tied to actually moving the project forward.
Now, of course, in the real world, plans change. In year 2, our company realizes, this project is going to be more expensive than we thought. So what do? They have to adjust. They recalculate their percentage of completion using that new higher cost estimate. And that changes the revenue they recognize. It's a dynamic process that keeps adjusting until the bridge is finally done in year 3.
All right, so that's the input method, all about effort. Now, let's flip the coin and look at its counterpart, the output method, which is all about results. The output method is perfect for situations where you can really easily measure what you've delivered. A law firm is a classic example. They can recognize revenue as they go because every single hour they bill is a clear, distinct unit of value that's been transferred to the client. It's simple and direct. Okay, so we've got a handle on recognizing revenue, but now let's throw a wrench into our bridge project. What happens if the expensive machinery they're using to build the thing suddenly drops in value?
Just imagine, our bridge company bought this huge specialized crane just for this project. It's sitting on their books as a very valuable asset. But then, bam, a new, more efficient type of crane hits the market, and suddenly theirs is kind of obsolete. It's not worth nearly as much. That drop in value has a name. It's called asset impairment.
Now, companies can't just ignore this. The accounting rules have specific triggers, red flags basically, that force a company to stop and perform an impairment test. It's all about making sure the value of an asset on the books actually reflects its value in the real world.
So when one of those triggers goes off, accountants pull out a specific playbook. It's a straightforward two-step process to figure out if there's been a loss, and if so, exactly how big it is.
Here's how it works. Step 1 is the recoverability test. It's a simple question. Is the value of this asset on our books higher than the cash we expect to get from it in the future? If the answer is yes, you've got a problem and you have to move to step 2. That's where you calculate the actual loss, which is just the difference between its book value and what it's worth on the open market today.
Let's use an example. This machine is on the books for $160,000, but an analysis shows it's only expected to generate $150,000 in cash flows from here on out. Well, 160 is greater than 150, so it fails step 1. We know for a fact that an impairment loss has occurred.
So now we do step 2, calculate the damage. We take the carrying amount of $160,000 and subtract the machine's current fair market value, which is $136,000. That gives us a loss of $24,000, and that loss has to be recorded as an expense immediately. For an investor, seeing an impairment loss like this can be a huge red flag that something has fundamentally changed for the worse.
And here is a critical rule to remember. Once an impairment loss is taken, it's a one-way street. You cannot reverse it. Even if the asset's market value magically bounces back a year later, too bad. That new lower value is its permanent new cost basis.
So in the end, you see, accounting isn't just a bunch of dry numbers. It's actually storytelling. The revenue recognition rules tell the story of how a company creates value over time, and the impairment rules tell the story of how it weathers unexpected storms. So the next time you look at a financial report, ask yourself, what story are these numbers really telling me about this company's health?